Hey guys, it's Julie here with TipRanks, and today we're taking a look at 3 high-yield dividend stocks under $20 per share. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 high-yield dividend stocks. These are all companies that are paying out a dividend with a yield of 7% or higher. One is even above 10%. On top of that, all 3 of these companies are priced at under $20 per share and come in with a strong buy consensus from Wall Street analysts. So we're going to take a look at these companies, what it is that they do, what exact dividend they pay, and of course what those analysts are predicting for the stock's future. We found today's stocks using the TipRanks Stock Screener. That is found right underneath research tools, and I was looking for a strong buy consensus from Wall Street analysts with a very high dividend, and to help narrow it down, I wanted some positive upside potential and at least a neutral or outperform rating on the TipRanks Smart Score. That gave us our list of companies down below, which I then sorted by price. Check out the stock screener for yourself over on the TipRanks website or by downloading the app on your mobile device. Links are in the description down below. Just before we get into today's stocks, this is a reminder that if you enjoyed the video, make sure you hit that thumbs up button and that you're subscribed to the channel. Now let's get right into our strong buy high yield dividend stocks. First on the list, we're looking at Anali Capital Management. They trade under the ticker NLY and are our most expensive stock here today, just under the $20 price point at $19.58. They've climbed 39% over the past 1 year and are fairly flat in the last 3 months, down 0.2%. Anali Capital is a REIT or real estate investment trust with a primary focus on residential real estate and mortgage-backed securities. And they have been notably successful in acquiring these assets, building up a total portfolio worth $75 billion. The firm has nearly $11 billion in permanent capital and $6.3 billion in total assets available for financing. In its last financial release, they stated that $66 billion of their total portfolio was held in the highly liquid agency segment. The company follows a diversified capital management strategy designed to create durable, long-term, risk-adjusted returns across varying economic and interest rate cycles. The company has a long-standing dividend policy with payments dating back to their IPO in 1990, and since that IPO, they've declared $26 billion in dividends. Their most recent quarterly dividend was 65 cents per share, which would mark their 7th quarter at this current rate, and a dividend yield of 12.82%, which is the highest out of our bunch today. Anali will be sharing their Q3 earnings report tomorrow on October 23rd, so one to keep a close eye on. It'll be interesting to see how they've done since the Fed's rate cut during the last. This quarter does follow an earnings available for distribution beat back in July for their 2nd quarter. For their 3rd quarter, analysts are anticipating that EAD to be 67 cents per share, which would be a 1 cent increase over last year's and fairly in line with their Q2, which came in at 68 cents. That was 3 cents better than analysts were anticipating. In that 2nd quarter report, their CEO and CIO said that they are encouraged by recent inflation data and signaling from the Fed, which suggest a near-term rate cut is increasingly likely as interest rate volatility appears poised to moderate and more dovish monetary policy is on the horizon. We remain well positioned for further growth given our substantial liquidity, prudent leverage, and nimble capital structure. Last week, we did have a 5-star analyst from JP Morgan increase their price target on the stock. The firm expects residential mortgage REITs to be the earliest beneficiaries of lower interest rates. Residential mortgage REITs are levered to falling rates via a positive duration gap, which should be immediately accretive to book value. Anali Capital does have 7 current analyst ratings, coming in as a strong buy with 6 buys and 1 hold. And the average price target comes in at $21.71, implying an upside potential of 10.7%. Looking at those ratings down below, on the low end we do have a hold and a buy, both at $20.50 for a slight upside of over 4%, while our high-end price target comes in at $23.50 from Compass Point for an upside of over 19%. Number 2 on our list is a stock we've been talking about well over a year now, and I do bring it up every few months, especially when we're talking about high dividend stocks. That is Energy Transfer. They trade under the ticker ET, currently priced at $16.40. The stock has climbed nearly 30% over the past year, and in the last 3 months is up slightly, just over 2%. Energy Transfer is in the hydrocarbon industry and is one of North America's largest midstream companies. Energy Transfer boasts a market cap of over $56 billion and a wide-ranging network of assets for the transport and storage of crude oil, refined products, natural gas, and various liquids. The network includes pipelines, tank farms, and terminal and transfer facilities and is centered on the Gulf Coast. Their crude oil segment includes over 14,500 miles of pipeline across 20 states, and for natural gas liquids, they have another 5,700 miles of pipeline. Energy Transfer is a master limited partnership, or MLP, so their dividend is paid out as a distribution, meaning you will get a K1 at tax time, so just take note of that. Now, they have been paying their dividend for quite a while, though they did have to decrease it in 2020. They've been steadily increasing it ever since. And their current quarterly dividend sits at 32 cents per share, giving you a dividend yield of 7.71%. They'll be sharing their Q3 earnings report in a couple of weeks on November 6th. This does follow mixed results back in August, where earnings were in line but revenue slightly missed. However, the stock did still increase as the company hiked their full-year profit guidance. For their second quarter, they reported earnings per share at 35 cents, which was in line with expectations, while revenue came in at $20.73 billion, missing by about $770 million. They said that they now see their full-year adjusted EBITDA coming in at $15.3 to $15.5 billion, after they said that volumes continued to increase with the addition of new organic growth projects and acquisitions, resulting in record-high crude oil transportation volumes. And last week, we did have an analyst from Bank of America reinstate a buy rating on Energy Transfer. They said that even in a softening oil environment, the stock is still startlingly cheap compared to how much cash could be paid out if CapEx and acquisitions ever slow even a little bit. With 9 current analyst ratings, the ET stock does come in as a strong buy with 8 buys and 1 hold. The average price target comes in at $19.56, implying an upside potential of over 19%. Looking at those price targets down below, we have quite a few coming in at $20, which would be an upside of over 21%. Our hold rating here is our low end price target with an upside of 3.5%, while our high end is this $23 for an upside of 40%. If you've made it all the way to our third stock today, then this is a reminder to make sure you've hit that thumbs up button. Third on our list, we're looking at DHT. Trading under the ticker DHT, they're currently priced at $10.93. Overall, they've gained 12.5% over the last year, but have fallen recently, dropping about 7% in the last 3 months. They are a tanker company, with DHT standing for double hull tankers. This is a modern mode of tanker construction designed to promote safety and prevent leaks. The firm is one of the independent operators in the global oceanic transport sector, specializing in the carriage of crude oil. They are a pure-play operator of VLCCs, or very large crude carriers, which are massive tankers, and they are the largest of the crude tankers plying the oceans today. They have a fleet of over 28 VLCCs, which are wholly owned by the company and operated primarily on a charter basis. Back in 2022, DHT announced their new dividend policy of paying out 100% of its net income to shareholders. Their CEO said that the key considerations behind this policy was the strength of their balance sheet and liquidity position in combination with no current plans for significant capital expenditures. Their current quarterly dividend is 27 cents per share for a dividend yield of 8.52%. DHT will be reporting their third quarter results on November 4th, and this does follow mixed results for their second quarter, where earnings per share did slightly miss, while revenue was in line with estimates. For their Q3, analysts are anticipating 17 cents per share, which was 2 cents lower than last year's. This follows their second quarter earnings per share of 27 cents, which did fall 1 cent short of estimates. Revenue, however, was in line with expectations at $103.7 million. Last week, an analyst from BTIG initiated coverage on DHT with a buy, noting that the company is positioned to take advantage of what they expect will be a multi-year tanker upcycle and allow investors to participate in the upcycle through an attractive dividend. The firm says after a mid-cycle pause in the crude tanker market, they expect the return of OPEC crude exports from the Middle East, combined with increasing Atlantic crude oil flows, to spur very large crude carrier activity. DHT is positioned to pay out higher dividends as VLCC rates move higher. The stock does just have 4 current analyst ratings, but comes in as a strong buy based on 3 buys and 1 hold. And the average price target comes in just above $14 per share, implying an upside potential of over 29%. Looking at those ratings down below, on the low end we do have our hold from back in August with an upside of over 19%, while our high end price target is that new rating from BTIG with an upside of over 46%. So that is a quick look at 3 high-yield dividend stocks, all priced under $20 per share and with a strong buy consensus from Wall Street analysts. Let me know your thoughts on these 3 companies and which one jumps out the most at you. I always love hearing from you guys. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you're always doing your own research and due diligence. Thank you guys so much for watching. I hope you have a fantastic day, and I'll see you back here next time.